So, you probably think your portfolio is pretty well diversified, right? But what if I told you that in some years the best part of the market can beat the worst part by over 100%? Yeah. You see, the market doesn't move as one big block. Different sectors are constantly rotating in and out of favor. And try to time that? Well, it's pretty much impossible for most of us. So, okay, let's dive into this and explore a new kind of systematic approach that's built to tackle this exact problem.
First, let's really get into the weeds on this problem. We're about to look at some data that shows just how wild these shifts between sectors can be. And honestly, it's pretty eye-opening. It perfectly illustrates why a different kind of strategy might be worth a look. All right, take a look at this. Back in 2017, the real estate sector was on an absolute tear. It was the undisputed champion, delivering a stunning 103% return. I mean, if you were invested there, you were feeling like a genius. But, and this is a big but, what happened next is the really crucial part of the story.
And boom, the very next year, 2018, that same star performer, real estate, completely fell off a cliff. It crashed, becoming the worst performing sector with a loss of 31%. This incredible whiplash, from hero to zero in just a year, is the perfect example of the sector timing problem.
And just look at the sheer size of that gap. A 106% difference between the best and the worst sectors in a single year. And this isn't some rare event. These huge swings happen year after year, which makes trying to be in the right place at the right time incredibly difficult.
And that just leads to the million-dollar question, right? If the leaders are always changing and the swings are this massive, how on earth can an individual investor possibly keep up? I mean, you'd need to be doing research 24/7 and have perfect timing, which, for most of us, is just not realistic. So, is there a better way to think about all this?
So what is the alternative? Well, it's a strategy called sector rotation. And the core idea behind it is actually brilliantly simple. Instead of trying to predict the future like some kind of fortune teller, what if you just focused on adapting to the market conditions right in front of you? Let's see how that works.
I love this analogy because it makes it so clear. Think about a cricket captain. A captain doesn't have one fixed team for every single match, right? Of course not. On a dry, turning pitch, they're going to load up the team with spinners. But on a green, grassy pitch, they're going to favor the fast bowlers. The strategy changes to fit the conditions on the ground.
And that is exactly what sector rotation is in the world of investing. It's a strategy where you move your money between different sectors, like tech, healthcare, or energy, based on which ones are best positioned to do well in the current economic environment. You're not just sticking with one plan, you're playing the conditions.
Okay, so the concept makes a ton of sense. But let's be real, actually doing it is a huge challenge. How do you pull this off without it becoming a full-time job? Well, this is where a systematic, data-driven fund comes into the picture. It's designed to turn this clever theory into a real-world investment product.
The whole solution here is to take the guesswork and, just as importantly, the emotion out of it. Instead of an individual trying to make these incredibly complex calls, a systematic fund uses data and a predefined set of rules to make those allocation decisions automatically. It basically solves that whole constant monitoring problem. Here's a quick look at the JioBlackRock Sector Rotation Fund. It's an open-ended equity fund, and it's benchmarked against the Nifty 500. A few things to note here: the indicative total expense ratio, or TER, that's the annual fee, is a pretty competitive 0.50%. Also, there's no exit load, which is a nice plus. But, and this is really important, it's rated as very high risk. Because it's an equity-focused, dynamic strategy, it is definitely not for the faint of heart.
Okay, so how does the fund actually make its decisions? This is where it gets really fascinating. See, it's not just some black box algorithm running wild, it's a blend of human insight and machine intelligence.
The methodology is called Systematic Active Equity, or SAE for short. This approach basically combines the raw processing power of AI, which can analyze just enormous amounts of data, with the experience and the final judgment of human fund managers. It really is a powerful partnership.
So here's how that partnership works. The machine does the heavy lifting. It sifts through millions of data points, everything from company financials to satellite imagery of parking lots and even online search trends to generate investment signals. Then the human experts step in to provide that crucial final layer of oversight. They look at the big picture economic view and make the final call.
This all comes together in a pretty straightforward four-step process. First, the system generates what are called alpha scores. You can think of them as just a rating of a sector's potential to do well. Then, the fund decides how much money to put into each sector based on those scores. From there, the AI helps pick the specific stocks inside those favorite sectors.
And in the final step, the fund managers provide that essential human oversight before any trades are actually made.
Now for the most important part of all, figuring out if this type of strategy actually fits your personal investment goals and your tolerance for risk. So let's break down the potential benefits and, of course, the crucial risks.
Before we look at any numbers, we have to be absolutely crystal clear on this. What we're about to see is a backtest. That is a simulation of how the strategy would have performed in the past. It is not a crystal ball, and it is absolutely not a guarantee of future results. This is a super critical distinction to make.
Okay, with that big disclaimer in mind, the back-tested data is still pretty instructive. The simulation shows that from late 2017 to late 2025, the strategy would have generated a compound annual growth rate of about 17.17%. Now compare that to 13.43% for the broader Nifty 500 index. But again, I'm going to say it one more time, this is looking in the rearview mirror, not a promise of the road ahead.
So, who should be looking at a fund like this? Well, it's really for investors with a long-term horizon. We're talking 5 to 7 years or even more, who are comfortable with the ups and downs of a high-risk product. On the flip side, if you're someone who needs regular income from your investments, or if you just can't stomach those big market swims, this strategy is likely not the right fit for you.
And that leaves us with the final question to think about for your own investing journey. As data and technology play a bigger and bigger role in the markets, you have to ask yourself, is a systematic AI-powered approach the right way to navigate the complexities of sector rotation? It's definitely something to think about.